Hello, everyone. My name is Max Riesman. I'm a portfolio manager I work in Boston. I work for a family office in Boston. I spent my career at endowments and hedge funds, and now I manage family office, and I'm an angel investor, and that's how I came across Reserve. I'm one of the early investors back when it was called Flamingo. That dates me quite a bit. I'm going to talk about the concept that's very powerful, and as most of the powerful concepts, extremely simple. It's called the Dragon Portfolio. The initial push on that came from a paper published by Chris Cole from Artemis Capital Management about 10 years ago now. So we took this concept and ran with it. So why Dragon? So Dragon is a mixed breed, right? Dragon is a mix of Serpent and the Hawk. So those two creatures, they're very, very different. And when they put them together, it's not dissimilar to yin and yang, dark and light. It's like everything. It has a duality embedded in it. So the concept is not exactly novel, right? You can see that this concept exists not only in ancient cultures like Aztec and Egyptian cultures, but it's in the Great Seal of the United States and the coat of arms of Mexico, and it represents a cosmic duality, the constant, eternal cycle of creation and rebirth. So let's think about the serpent cycle. So this is a concept of Ouroboros. You probably, most of you probably have heard of it. It's like serpent eating its own tail. So this is what really describes the system of capitalism. So how do we start? How does the cycle start in our system? So it starts with natural growth. It begins with favorable demographics, credit expansion, and low volatility, trust in institutions, strength, and then you have a capital formation that's driven by these new things, and that's think of it as a spring. Then it goes into self-consumption. Then it goes into debt expansion. So to increase that, it's great. So right now we have now great innovations. Things are going great. So like any human beings, we want more of that. So that goes into debt expansion. So what does it mean? That means fiat devaluation, and debt replaces value creation. You need more and more debt to create less and less value. Right, then monetary policy becomes increasingly accommodative. Debt grows faster than productive capacity. Then financial engineering overshadows, real innovation, and asset prices disconnect from fundamental values. You have this cycle goes into corruption. Then the serpent keeps on eating its own tail. So cycle goes into corruption. You have wealth inequality widens dramatically. Speculative investments dominate markets. Regulatory capture and monopolistic behavior increase, and social contract between generations weakens. Does it sound familiar to any of you, like from especially yesterday's discussions on the macro? And then it goes into self-consumption. So the serpent, like Ouroboros, the serpent devours its tail into oblivion. So we have debt service overwhelms productive capacity. Central bank interventions become less effective. Market volatility returns with devastating force. Social unrest emerges as prosperity fades, and the cycle, is primed to start again. So it all goes crushing down, and then it's rebirth. It works the same way in nature, right? When you have this giant forest fires, there's a new forest that grows out of forest that gets burned, right? It works the same way. Once in a while, though, you have another phenomenon represented by hawk. By the hawk. So hawk represents the forces of creative destructions, then emerge when growth systems become corrupted. This can be manifested in two different fashions. So the hawk has two wings, right? One wing is deflation, the other wing is inflation. Left wing, it's debt defaults and credit contraction. That's like think of 2008. Asset prices collapse and wealth destruction. Then you have deflationary spiral as cash becomes king as the most valuable valuable asset, and increased savings rate amid economic uncertainty. Again, 2008, 2009, think of it that way. And then it leads to financial crash, extreme volatility, liquidity crisis, wealth inequality, and trust in institution erodes very, very quickly. The right wing is an inflation wing. You have, it's a path to the same thing, just a different way. Because you have currency debasement, asset inflation, resource scarcity that comes with people reaching out for real assets, and social instability as a result. Right? So ultimately, the Hawk destroys the corrupted growth cycle, and it goes back into rebirth. So the challenge is formidable, right? How do you create a 100-year portfolio? If you are tasked with the one simple thing, create a portfolio not for yourself, but for the future generations. Like, what do you do? Right, so we need this portfolio to navigate secular booms and cyclical busts. We need the true diversification because the portfolios that are being offered now by mainstream TradeFi or even DeFi, they're not truly diversified, and we'll talk about that. A lot of people think that people can time the market. Most of the people cannot. In fact, there was an interesting tidbit. Victor Hagani is a guy who used to be at the LTCM, and now he has his own firm. He published a paper where he proved that to determine whether actually fund manager delivers real alpha, it takes about 200 years. So timing is not something that a lot of people can do. So, and you have to have this we all, guilty of short-termism, so now we need to go back and think of a generational perspective on things. So we need to balance growth and protection. So we need something in the portfolio that would work in both scenarios. So to understand why we need that, we need to understand where we are now. So we have to, again, not think like what market is doing today or yesterday. We need to think about the unique period that we've just lived through. So we are at the end of the 40-year super cycle. So in 1980, that's when the interest rates peaked. That's the beginning of the cycles we lived through. And this is quite unique because it was driven by demographics, right? It's a boomer generation that has driven the markets, right? And now, 2017, retirement begins, and we are facing a true regime change in the market. So the Hawk is rising again. So we just talked about Serpent, right? And some of the things we talked about the last stages of the Serpent cycle, it's just precisely what was talked about yesterday: the debt issues, inflation, and income inequality, everything and anything, right? So we are at the last stage. So now we have the Hawk. And the Hawk, what is the Hawk doing now? So for the first time since the 30s, the Hawk is truly challenging the entrenched debt that exists in the Serpent cycle. So we're at that inflection point where the decades of debt accumulation, we've reached unsustainable levels, and something will happen. So then you have capital withdrawal. So boomers are retiring, capital is being withdrawn. You have entitlement crisis. We talked about that yesterday ad nauseum. You have policy reversals, and you have true portfolio vulnerability. So what is the portfolio vulnerability? So if you look at the traditional financial industry, whatever is offered, most of the stuff that's being offered to people, to civilians, is 60-40 portfolio. It can be called different names, risk parities, like fancy names like risk parity. Risk parity is just leverage 60-40. But the 60-40 portfolio, 60% debt, 60% equities, 40% debt. Comes in different flavors, but at the end of the day, it's all the same. And why is it being offered? Because it worked. It has worked, tremendously over the past 40 years. But you can see that to be able to to be able to actually put it in perspective, you have to see where the returns came from, or what time period the returns on the 60-40 portfolio came from. So the 91%, think of it, 91% of all returns on a 60-40 portfolio came from the last 40 years. Before that, that portfolio would suck like big time, right? So, and then what happens is that people, like big firms and small firms and mutual funds and everybody else, they don't look at the data because data is not like widely available, because those like people like at Fidelity will tell you, I'm not going to look at the data before 1980 because it's not a good quality data, right? If you can punch into Bloomberg, it works, but if it doesn't, no, right? So yeah, from 1980, that's exactly true. 60-40 worked. So since we're entering, so the whole modern portfolio theory is built on assumptions that worked for the last 40 years, but not prior to that. And my assertion, and not looking into the future. So the $1 trillion question is this. So the average investment advisor is 52 years old, right? This guy has never seen a true bear market, never. He's never lived through true inflationary period, right? All that guy has seen is a bull market in everything, right? In all assets, right? And that's what he's he based his advice on his or her experience, and then he's giving a sound advice based on his experience. So he's fulfilling his fiduciary duty, right? And so 91% of returns of 60-40 came from this period. 94%, think of that number. 94% of all equity returns came from that period. 76% of all bond returns came from that period, right? So when inevitably markets return to norms, these numbers will be different. So the left wing of the hawk, deflationary deleveraging. We know the examples of this episode. So the Great Depression, that was deflationary period. You have a financial crisis in 2008 was hugely deflationary, and then Japan's lost decade. Japan has experienced deflation until like very recently. The right wing of the hawk, inflationary deleveraging. Note that these things don't have to. It's not either or. They can occur concurrently, right? Or sometimes simultaneously, different parts of the world. But they have one thing in common, and they have the word deleveraging in them, because both cause deleveraging, right? And deleveraging is associated with value destruction, right? So what are the characteristics of inflationary wing? You have potential stagflation, like we had in the 70s, Weimar hyperinflation, don't have to tell you about that, and we have helicopter money that we've been experiencing since since COVID. That chart was in somebody else's presentation, yeah. So it's going around, but this is telling you. So what these last stages of Ouroboros, the serpent swallowing its own tail, causes this. Income inequality, because you only benefit from helicopter money if you own financial assets. In the majority of U.S. and in the world, the majority of people do not own that, right? So this huge gap, that's equals social tensions, and that's what we've started to see. So another issue with our industry is that it's okay to fail conventionally. Right. So if I'm an investment advisor, I have an incentive to, if I were to fail, I better fail with everybody else. So if market is down, and I am down like maybe 100 basis points less, or 100 basis points more, no one is gonna fire me, right? Because the market is down. Like, what do you want, right? So our industry is based on this failed concept, that on the herding concept, and that it exists because of the deeply entrenched sort of a feature us as a Homo sapiens, because we survived as a species because of the herding, because we're able to cooperate with others, right? To be contrarian is really suicidal. It's like, think of it like if you're a contrarian and you're hunting some big creature like the mammoth, and you don't want to be contrarian. You want to be in a herd, right? So our behavior like the prefrontal cortex formed, as we know it now, 50,000 years ago. So nothing has really changed. So it's okay to be in a herd for 99.99999% of the people. So if you were to fail, you better fail, better fail along with everybody else. So as a result, you have under-allocation to non-correlated alternatives. Because if everybody is in the equities, you want to be in equities. You have an incentive to under-allocate to alternatives, right? So this is the Achilles heel of traditional portfolio. You have zero-bound interest rates, rising inflation, and correlation breakdown. I'm going to go through quickly because I don't have too much time. And this is another issue, the pension crisis. We have a systemic risk in the pension system because the assumptions, the return assumptions are not realistic. So when pension funds will start, will be short on funding, what they're going to do, they're going to issue bonds, and the federal government is going to bail them out, and that money is going to go into the system. Asset prices rise, the value of money goes out the window. The reach for yield. Market is proliferated with short volatility strategies, like selling calls. All sorts of strategies, they're not called short volatility, but they are. And that's because this strategy has worked. So this is volatility, call it volatility blind spot. So this is a strategy. Unfortunately, you can't see the whole screen, but this is a strategy of popular strategy. So if market goes, it's a systematic strategy, algorithmic. So if market goes down, you buy market at the end of the day, and then you look at the returns the next day. So you've made since if you were to deploy the strategies in 1980 to today, you would have made 20-odd% annualized. If you were to do it in any other period, it would have gone bust, not multiple times, right? Yeah, it's more on the short volatility. So this is an interesting chart. So this is a correlation between stocks and bonds since 1920, right? So you can see, it's like slapping spaghetti at the wall, right? There is no negative correlation. There are different regimes at different times, right? But that tells you that 60-40 portfolio is a suboptimal portfolio over a long period of time. Going back to philosophy, the law of cosmic duality is not unique to financial markets. It exists in the theology, the Buddha's middle path. It exists in the war. The reason Genghis Khan won most of the battles because the strategy that he attacked and retreated, in cooking, so if you like bake a cake, it consists of the chocolate and the flour. If you try these two ingredients separately, they're not particularly tasty. But if you put a little baking powder and put it in the oven, that creates something completely different. That has what we call an emergent property. In sports, Dennis Rodman, he created offensive efficiency by mastering rebounds. So he actually didn't score too many points, but he rebounded. He did the rebounds. So it exists in music, and in investing. So you want assets that thrive in different environments, not in the last 10 to 20 years, but in different environments. So they have to perform great both in growth and in the decline. So this is cosmic duality in investing. So you have assets A, B, and C in the first chart. So which assets would you want to combine to create an optimal portfolio? I'll give you the answer right away. You want to combine not the A's and B's, despite the fact that it looks like if you combine A and B's, it's going to give you a greater return. But you want to combine A and C's because they're uncorrelated. So per unit of risk, you're going to get a much greater return in a combined portfolio A and C's because the assets are truly uncorrelated. So what do you do? Like, what is the dragon portfolio? Again, as most of the powerful concepts, it's extremely simple. So this is a portfolio based on research of price series for hundreds of years. So first you have to 24% allocation to growth to liquidity-driven assets, And that includes real estate, equities, everything that's Bitcoin, like everything is driven by liquidity. Then you have active long volatility, 21% allocation, fixed income, 18% allocation, physical gold, and commodity trend. So as you can see, some of these assets, some of these are very familiar to you, like liquidity-driven assets and fixed income, but others are not. And that's because people don't do them. They're not as easy to implement as buying, SPY or TLT, but they truly perform in environments when other things don't. And why is that? So that's a performance annual return, 14.4% with the Sharpe ratio of 0.98 for the portfolio like that. Right, it would have been tested over, on the price series of 90 plus years. So, and why does it work, right? It works because the distribution of returns are in the tails. Most of the time, market does nothing. So the most of the returns are in the tails, in the top 5 percentile, both positive and negative, right? It's like, I don't remember the exact numbers now, but every year they look at the number of days with the highest return in the market, and you really want to be in the market for 5 days a year, or like 10 days a year. Because returns are concentrated, they're not evenly distributed, and that chart shows that. So if you long these assets in market, is roaring higher, you will perform, because the returns are concentrated in the tails. This is liquidity. Liquidity is cyclical, right? So this is liquidity cycle since 1968. You see, it has a cycle to it. So liquidity is cyclical. So that's what's going to drive liquidity-driven assets. And this below is a correlation of change in liquidity versus Bitcoin. That's what drives Bitcoin, liquidity, right? We live in a closed system, right? So there's a number of assets. We don't trade with Mars just yet. Maybe Elon will fix it, but so far the system is closed. So you have a liquidity pool and you have a number of assets. So then it's supply demand. That's all there is to it. So gold, we've talked enough about gold, but gold, just one quick note on gold, it's not an inflation hedge, that's a fallacy. The gold is a hedge against trust, in loss of trust in institutions. Right? If you actually look at the numbers, gold is a poor inflation hedge. But what we hedge with gold is a lack of trust in the government, because gold is a neutral asset, so is Bitcoin. Right? And that's the main thing we want to hedge with gold. Active long volatility. This is your crisis alpha. That's what performs when nothing else does. And presenters yesterday rightfully pointed out that when proverbial shit hits the fan, everything sells off, including gold and Bitcoin and stuff like that, right? Because of the liquidity, because people liquidate. It's not about fundamentals, it's about liquidity, right? And that's what this performs. This performs in a spectacular fashion. Not easy to implement, but that's when this performs. This is another asset class that is highly valuable for this portfolio because it's uncorrelated to the rest of the stuff. This is a commodity trend following. Commodities tend to trend. It's just the feature of, it's not a bug, it's a feature of that particular asset class. So if you boldly allocate to that asset class, it will perform irrespective of the rest of the market, because commodities have physical sort of constraints and features that make them a trending asset class. And the biggest challenge to the whole thing is cultural, really, right? It's the discipline, it's emotional discipline. Average individual investor is not emotionally equipped to reallocate, right? To rebalance. And to allocate to non-traditional assets, because we're trained like a Pavlovian dog on the 60-40 portfolio, right? So you tell average investor you have to buy commodity trend following, you're gonna get strange looks, right? Then it's hard to be a contrarian. It's really, really hard, because it's contrary to evolution of us as a species. And finally, there is a generational bias. If people experience bull market for all their careers, we expect we think in a linear fashion. We expect tomorrow the same that was yesterday. right? So it's really, this portfolio makes you allocate. So what you need to do is you need to become a dragon. You need to have in your portfolio assets that perform in both regimes, in the Ouroboros regime and in the secular change regime. So you have to take a really long view. So the devil is always in details, right? It's a very powerful and very simple concept. Yet it's hard to implement. It's not, it requires emotional discipline. It requires reallocating when you're really scared. It requires a lot of things that normally we do not have. So that's why I'm so excited about Reserve, because that's what Reserve is hopefully going to do, to create something that will, not only that create something that will preserve the wealth for generations, not just for tomorrow or the after tomorrow. So I tried to make it quick. So if you have any questions, happy to answer. Oh, one thing to add, that's not a philosophical concept. That's how we run the money.
I have a question. Have you considered the fact that central banking has essentially changed 180 degrees over the last, say, century, and we're far more activists, and that limits the drawdowns, certainly in length of time, and allocating 21% to a long vol strategy, in your series would have worked because you had some really bad drawdowns or periods in the Great Depression, but that might be a drag on the rest of the portfolio going forward.
You're exactly right, and that's the guy is a guy. His name is Bill Flickenstein. He wrote a book called about Alan Greenspan, and that book is called The Menace to Society. Because I think it's really started with him, the whole central bank activism thing. You cannot change the cycle, and Paul Volcker knew that. But we lost that notion that cycle cannot be changed. It can be suppressed, but cannot be changed. So we're seeing what we're seeing now is the result. Is the end of what started in like late 90s with the first LTCM bailout, right? You can be activist as much as you can. There is it's like physics, right? There has to be an escape valve somewhere, right? So the escape valve in this particular, in our particular case, is the value of currency. Not versus other currencies, but versus real assets, and that's where the hawk asset classes actually work, because the more you suppress, the bigger the explosion will be. And there's a paper on forest fires in California, because they compare forest fires in California versus Baja California, right? And it's the same place, it's just different way to manage it. So in California we suppress until we get boom. In Baja California, no one does anything, and it's like small fires here and there, but never a big one. And people in the forestry actually learned it a long time ago. I was a few years ago in Yellowstone, and they told us they used to put down the fires. They no longer do that because they don't want the big one to occur.
How do you allocate to long vol? You guys have ISDAs that you have.
Not easy. In fact, Chris Cole fund went bust, despite the fact that he's one of the smartest guys I know, by being long vol. It's not easy. There are many ways to do it. None of them are, as easy as pressing the button. Sometimes like, that's the portfolio I give to my friends and family when they ask me what do I do? I go, okay, here. Sometimes I tell them like, okay, so you can long vol, you can do this, option structures on VIX futures, or if you don't want, just keep it as cash, because long cash is effectively long vol.
Yeah, it kind of reminded me a little bit, like, I'm sure you've heard the statistic, like if you had like 2% since when Jesus was alive, you'd have, more money than before.
Right.
Like, I know you talked a little bit about like the income inequality piece. Like if your portfolio is growing at 5% a year, but the real economy is shrinking, it eventually, like, you're just taking from everybody else's wealth eventually, right?
Yeah.
And so, like, isn't there like a natural stopping point to this where like your only real hope is to actually like invest in growing the real economy?
Well, it depends what kind of volatility you want to endure, right? Because the key to outperformance is not actually have a highly performing portfolio. The key to outperformance is to avoid drawdowns, right? It's a simple arithmetic, right? Because you're making, I don't know, 50% a year like everybody else, but if you lost 50%, you need 100% return to make it all back, right? Denominator is different. So the key to outperformance is actually avoiding drawdowns in your portfolio. So if you just invest in growth assets and you did it at the wrong time, you're running the risk of never recovering. I mean, we live in a US-centric world. Like, look at the Japanese, right? The people who bought Nikkei in 1989 still have not recovered their money. In nominal terms, mind you, right? Forget about real terms. In nominal terms, they're still underwater.
But I just meant more in like a social context.
Income inequality is not a bug; it's a feature. We have to create income. We have to have income inequality as a stimulus for society. Because if there is no income inequality, there is no stimulus for people to achieving greater income. But it's a cyclical thing. When it goes too wide for artificial reasons, right? It's just an explosion, and it goes. You have social unrest, you have pitchforks, and then goes back to square one and starts growing again. There's just no way to escape it. We as again, I'm talking a lot about species, but we as species, we are cyclical because we are herding. It's what we do. We're herding. It's much easier to do things in a herd than by yourself, right? So that's sort of the underlying thing of everything. This cycles. Any other questions?
All right, that worked first time. I'm going to stand up because I won't be able to sit still in front of this microphone anyway, so I thought I would go ahead and just give it a shot standing up. I'm honored to be speaking to you today. What has been apparent to me, I put together this presentation a couple of days ago, and as yesterday went on, and I watched all the presentations, and today went on, I watched all the presentations, what became obvious to me was that I'm not totally sure which slides I really should be focusing on and what I should be saying on each slide, because my focus kept changing as I was watching other people. And so I don't exactly know what I'm going to say. So I hope you're looking forward to finding out what I have to say, because so am I. But the bottom line is that I'm here to talk about USDi, and USDi is an inflation-linked stable coin. First, a little quick thing about me. First of all, two questions about this slide. One is, yes, the inflation guy does have a trademark. I am the inflation guy. And the second is, yes, that's anatomically correct in all respects. I don't dress that way anymore because they don't have phone booths. And without the phone booth, getting the bodysuit on just is really hard. So I don't dress that way anymore. But I am the inflation guy. For the last quarter century or so, that's like all I've been doing is inflation. And that's why when I was sort of invited to speak to this group, to Reserve, I was like, this is perfect. I mean, these guys think the way that I think. And so, again, a lot of what we've heard in the last couple of days is about finding an asset that, defends your money. That's literally the slogan of my podcast, is defend your money. So, but my background is TradFi. And bulge bracket shops. I researched sales and trading, traded options, but then for a very long time I traded inflation derivatives, and inflation swaps, inflation bonds, things like that. I do want to point out that there was a second CPI contract that was listed in 2003. So earlier we heard about the one for the CSCE. That was in 1985, and that nothing didn't really trade at all. In 2003, I introduced a CPI futures contract at the CME, and I was the sole market maker for it. It was a terrible design. I designed it. It was terrible. It looked like Eurodollars. It made no sense at all. We traded it for a couple of years, and it eventually died. And since then, we have not been able to persuade the CME to launch another CPI futures contract, but that will happen. But anyway, I'm a TradFi guy until fairly recently, and USDi is an ERC20 token. Here's the goal of the project. Essentially what happened was I was on a podcast, well, it was my podcast, and I had the guy who is now my co-founder talking about choke point 2.0, getting your assets back into TradFi, and that turned into stable coins. And I asked the question, because it seemed weird to me to have stable coins in a DeFi context, because the reason kind of that Bitcoin sort of all started was this fear that the dollar system is doomed. And if that's the case, the last thing in the world you'd really want to do is have a coin that's linked, it's tethered, no pun intended, to the thing which is going to crash, right? So that seems sort of weird. But I asked, is there any such thing as a dollar that's stable in real space? And the answer is, people have tried it, but there's nothing that's done a compelling job of it. And so that's what we set out to do. So here are a couple slides that I was going to talk a lot more about, but I just want to emphasize a couple of aspects about them now. And that is, I call this an inflation-linked stablecoin. Technically, that's not technically true thanks to the Genius Act. We can't really say this is a stable coin because it changes in value over time. But that's absurd, and I'm very offended by this. Is the dollar stable? Well, it is unless you're a yen investor, in which case the dollar is very unstable. The yen is terribly, terribly unstable unless you're a yen investor, in which case the dollar is terribly unstable, right? So it all depends on your frame of reference. And we're specifically, in talking about stable coins, we're talking about a very unique, very, very specific frame called the nominal frame. And it's simply defined in the fairly arbitrary parental sense of because I said so. That as long as that number doesn't change, it's stable. Okay, well that's fine. Again, in the very narrow parental sense of because I said so, that is a stable coin. But as we all know, we've spent a lot of time talking about it in the last couple of days, it is not stable in any sense that we actually care about as investors. We care about what you can buy. And you can deflate the dollar, you can deflate wealth by any kind of inflation index that you want to. The one that I'm pretty sure is wrong is if you don't deflate it at all. And that's the nominal frame. So that's the one frame I'm pretty sure isn't stable, is the one that's called a stable coin. So I'm pretty frustrated about this. Anyway, that comparison that I just made of foreign exchange and the nominal real frame isn't just sophistry. These frames are all tied together by purchasing power. What determines the exchange rate between yen and dollars? I mean, lots of things. But the main thing that determines kind of the gross exchange rate, the reason it's 100 to 1 and not 1,000 to 1, not 10 to 1, is purchasing power. A yen buys 1/100th of what a dollar will buy, roughly, right? So, and so that's grossly what powers the overall exchange rate. And the same thing is true in the sense of the real versus the nominal. If we were to travel back in time to 1983 and we bought stuff with $1983 or $2024, we would find that we needed about $3.20 to buy what one $1983 would buy. And so if we had time travelers doing this foreign exchange, and it's just foreign exchange, that exchange rate would be driven by the relative purchasing power of a $2024 versus a $1983. USDi is merely trying to set in stone, to set in one place in time the value of a dollar. And the USDi is going to be indexed to December 2024. It's a December 2024 dollar when you put it in your pocket. It's December 2024 dollar when you take it out of your pocket, and it buys everything a December 2024 dollar would buy. And so USDi and then the future price level is an exchange rate. By the way, not exactly a super insightful observation that this is the same as an exchange rate. Jero and Yildirim 22 years ago wrote a paper observing that the similarity between the exchange of different currencies, different times, is so similar to the exchange of different currencies that you can use an HJM model that we use for valuing FX derivatives to value inflation derivatives. And this gets me back to the whole stablecoin and securities, specifically the security issue, which will come up in just a moment. Is the yen a security? No, the yen is a currency. It's not a security. Then why is an inflation-indexed stablecoin a security? It meets the definition, the SEC definition of a security, because it pays a return. The SEC thinks that getting inflation is a return. And so that's a security, but the yen isn't. And these are analogous things. So another thing that sort of annoys me. Okay, so I'll go a little bit fast through this slide because we all know why inflation-proof cash is so important. Again, if I was talking to my kid's high school class or something, this would be a much more important slide. But the bottom line, we all know why inflation-proof cash is important. But to me, I think of cash as an option on future opportunities, right? So we keep dry powder in your portfolios because Tesla might someday drop to a low enough price that it makes it worth buying or something. You keep cash because you're a private equity investor. There might be a capital call. You want to be ready for that capital call, so you keep cash around. I keep cash in my wallet when I go out and walk down the street because I might have an opportunity to buy a Rolex at a great price and the guy doesn't take Visa. Okay, so cash is an opportunity on those. Is an option on those opportunities, and in fact, it's one of the reasons that people carry cash. Is called a demand, a precautionary demand for cash. The cost of that option is inflation. When you are in a country like the U.S. with very low stable inflation most of the time, you tend to carry a little more cash. Because you want to partake in those opportunities. But if you go to an economy that has very, very high inflation, you'll find people do not walk around with cash very much because the cash changes in value too fast. So the value of that opportunity, the opportunity cost of having that option on the opportunity is just too high. And so if you make inflation-proof cash, then you increase the reason to hold cash and you increase the portfolio of potential opportunities you can go and exercise. And as an aside, and again, something that Evan just said, talk about eradicating inflation. One of the neat side effects about giving people an incentive to hold cash is when people hold more cash, it lowers money velocity. Because velocity is the inverse of the demand for real cash balances. People hold more cash means lower velocity. So ironically, if you give people inflation-proof cash, you will tend to lower inflation as a matter of policy. Again, has nothing to do with USDi, but it's fun. Okay, so let's talk about USDi. Again, everything that's old is new again. No such thing as a real inflation-linked stablecoin, but the idea of an inflation-linked currency is not new. The first example that I can find of an inflation-linked currency, an explicit inflation-linked currency, is the unidad de fomento that Chile introduced in 1967, still exists today through hyperinflation and very high inflation. And the reason that they introduced this inflation index currency unit is that at the time, very high inflation in Chile, and what that means is that people who are contracting, wage laborers or supply chain contracts. If you're going to contract for 1,000 pesos per widget, and you have some idea, maybe next month it should be 1,100 and it should be 1,200 after that, but you don't have a whole lot of visibility on exactly what's going to happen to inflation, so you can't have long-term contracts. And so Chile said, very, very intelligently, they said, look, write the contract, we're going to give you this new currency called the UF, write the contract in terms of UF, and we will tell you what that exchange rate is, so when it comes time for you to deliver UF, we'll tell you how many actual pesos you need to deliver. It didn't actually circulate, but the value of the inflation-linked currency is obviously very high. Argentina recently has introduced a similar thing, and various countries have done this sort of thing. But it's never circulated as an actual currency. The point of USDi is to create something that circulates, albeit in a DeFi context, as an actual currency. So USDi, which launched in April, still very, very tiny, is a fully backed, unlevered ERC20 token that pays the holder back the original notional amount plus the inflation accretion during the holding period. So the value, and you can find the value on our website, it updates every block. You have to refresh the page. The value is always today's inflation index divided by 315.605, which is not random. It is the inflation index for December 2024. It's not just kind of like the theoretical value. That's the value at which we will mint or burn it. We will mint or burn it at the mid, your size, minus a small transaction fee, and we'll tell you later exactly how that works. But the indexing is done exactly the same way we do it for tips. Well, not quite exactly the same way, in that we take the CPI index from 3 months ago, 2 months ago, we interpolate between them. Tips do it on a daily basis. It doesn't work for a 24/7 market because you'd have these little jumps at the end of every day, so we interpolate every block. But other than that, it's exactly the same as the way tips do it. And we will mint or burn anytime for whitelisted wallets. Okay, so here's the annoying part. Whitelisting is necessary because, as I said, we believe the SEC is going to consider this a security. And so we've filed it as a Form D 506C security, which means we can only sell it directly to accredited investors that we do KYC and AML on, and we're not going to do that for a $20 trade. And so, fortunately, there is an analogy for this. The ETF ecosystem works exactly the same way, that the average person, we found out today, the average person cannot create an ETF share. The registered participants are the ones who can create or redeem ETF shares, and they are market makers to everybody else. That's the same way this will work. We're going to have market makers who are whitelisted. We'll whitelist anybody who wants to invest a sufficiently large amount, and then you can just access the contract and mint or burn at your leisure. But the idea is to have a number of market makers who will always be able to mint or burn at the mid and then make markets around that in various DEXs and SEXs. And so we're busy talking to a bunch of different market makers to try to see what we can line up. So now, again, I think this is like the yen. I think there's a pretty reasonable argument you can make that this really shouldn't be a security. It's a stable coin in real space. It's kind of dumb that this would be disadvantaged when it's a better stable coin than a stable coin, but we have not yet made that argument to the SEC. And being a TradFi guy, I don't want to do it first and then ask forgiveness later, although I'm less likely to be thrown in jail now than, say, a year ago. Okay, so what happens? How do we do this? Now, this is the part that I know I probably should have had many more slides about exactly how the portfolio, what the portfolio looks like. I'll tell you a little bit about what the portfolio looks like. I will tell you, we will have the value of the backing portfolio reported by the administrator every month, be audited every year. We'll release the holdings with a little bit of a lag. Very transparent, all very high quality stuff, and I'll tell you about that in a second. But essentially, when somebody mints USDi by presenting the backing token, which is USDC, we off-ramp the USDC, and that goes to a TradFi portfolio. And I'll tell you what that portfolio looks like in just a second. I would love to have that portfolio on chain. And once there are enough assets, if we can get all of the assets that we use on chain, then I would love to do this on chain. But right now that is very hard to do. But what's important, obviously, if you're going to do this, is that you have, and this is why everyone says that you can't do this, it's very, very hard to do this, is that you have to have an underlying fund with low volatility and high correlation to US CPI. Those are both important because if you have either high volatility or bad correlation, then what happens is you have a couple bad months, suddenly your reserve fund is at 85%, there's a run on the bank, and the token collapses. So very important that we have both of those things. So here's a nice little chart. On the x-axis is correlation with month-on-month CPI, so very, very short-term CPI. And then volatility is on the y-axis, although I've inverted it and put it in log terms. So if you want something a really, really good backing asset, it's going to be up here, which is curiously blank. Here are some assets that, just for shits and giggles. INFL is an ETF that's supposed to be an inflation hedge. TIP is a TIPS ETF. GLD is a gold ETF. Bitcoin. Bitcoin is wonderful. It's almost uncorrelated to inflation. It almost is uncorrelated. But it has a vol of 60 or 70%, so not so good. TIPS in gold, or 8 to 14% vol, still way too high, and moreover, maybe surprising, on a month-on-month basis, they are negatively correlated to inflation. Over a long period of time, they're positively correlated. Long period of time doesn't help for something like this. Fortunately, for the last 3.5 years, I've been running a fund that has a 0.4% correlation, about a 2% vol, and that is the actual backing, reserve backing. USDi, had it existed, would have had a vol a little bit more than 1% in nominal space, obviously 0 in real space, and a perfect correlation. And so this is a pretty reasonable backing asset. So in the reserve protocol context, this is what we all want, right? We want to have tokenized commodities, tokenized equities, tokenized gold, tokenized real estate, all these things tokenized in real space. That's how we're going to create an inflation-resistant portfolio, an inflation-resistant coin, or a bunch of, let 1,000 flowers bloom, a bunch of different inflation-related investments and coins built for the long term. I would love to you could put together a portfolio of this and call it a just real return token, a JRR token. And I really want to have a JRR token. But you have to have all these things first, and we don't have most of these things yet. But once we do, and I got to throw in, stable coins are way down here because this axis and this axis are in real terms. So stable coins have deeply negative expected real returns. So when you draw your hypothetical efficient frontier, stable coins will just never, ever be there. And so if you really want something that's going to be an inflation-linked stable coin, you really want something way off to the left. And by building these portfolios that we've all been talking about, you can get something that's just pretty low volatility and has some positive return to it. What we have just added is the ultimate risk-free asset in this context with 0 real return, 0 expected real risk. And what that does in the portfolio context, by itself, great asset. If you just want to hold that in lieu of dollars, wonderful. It could be a great asset for ugly cash, right? Wonderful thing to hold. But it's also a great building block for any of the other stuff we're doing, taking these other neat real assets and tokenizing them. But now you can get closer to that ideal axis. You can get better real return for the same risk or have less risk for the same real return. So I'm just about out of time, but I want to talk really briefly about phase 2 because this is where the scores can really mount up. People get really excited about this because this is something I've been trying to do in TradFi space for a quarter century, since I was back at Barclays and said, let's take TIPS, put them in a trust, like a CDO, will issue coupons linked to individual inflation components. Turns out to be really hard to do in TradFi space. In phase 2, once we have enough float here, we're going to allow you to present the coin and split it into various inflation subcomponents, okay? Or reverse that trade, give us the components, and we'll give you USDi back. So one potential basket, for example, might have college tuition and fees, medical care, energy, food. These all add up to CPI. We're not minting and burning each one, so we don't have to figure out a way to back, other core goods and services. But because they all add up, because we allow that arbitrage of splitting the coin or reconstituting the coin, there's a joint arbitrage condition that will make sure that medical care doesn't go to $1 billion and other core goods and services doesn't go to 0. That joint arbitrage will kind of ensure that stays somewhat rational, but now you'll be able to put together your own personalized portfolio. We could also do this geographically. If we launched a coin in Europe, we could have it by different countries. So you could have a Dutch stable coin, which, the Dutch inflation-linked asset, which they don't have right now. There's no asset specifically linked to Dutch inflation. If you're a Dutch pension plan, that would be a nice thing to have, right? And we can really do this right now because of what backs, so what's in the portfolio right now for US dollars is a lot of it, some of it you would expect, right? So a lot of it very short-term inflation-linked bonds, but also things like currency, because core goods tends to be correlated to the FX rate. Gasoline, if you want to induce positive correlation to CPI, put a little bit hold gasoline specifically instead of holding more tips to represent the gasoline, and you'll get that additional correlation. Sometimes agricultural commodities, things like that. There are ways to replicate shelter and so on. So we try to replicate each individual piece rather than merely just hold short-term inflation-linked bonds. But you could hold just very short-term inflation-linked bonds and do okay. By holding different pieces, we also are able to outperform the index, which gives us a little bit of a cushion over time to the portfolio. Yes, oh, and then finally, we can do the USDi coin trick any place that there are, reasonable assets. We can do it in, Argentina, for example, because there are inflation-linked bonds in Argentina. We can do it in Brazil. We can do it in Europe. Africa would be more difficult, but we can do it in Mexico and various places like that. And that's the ultimate plan. So finally, my co-founder is a guy by the name of Andy Faley. He goes by FX Poet. For many, many years, he's been writing a daily market comment, and he writes a market-related limerick at the beginning of each one, which to me just is insane. But he wrote this for us. So from Bitcoin to Tether to DAI, the world is embracing DeFi, but one thing is lacking: inflation-linked tracking. The times come for USDi. So anyway, those are my digits. And I'm happy to talk to anybody about anything vaguely inflation-related or USDi related. So thanks very much. Appreciate it.